Well, the market continues to look very sloppy after this historic post-election rally. The rally, of course, benefited from the index that's benefited the most is the American-centric Russell 2000. As President Trump is focused on Buy American, Hire American, that fits those businesses perfectly. But today, the Russell took a larger hit than the other indices, and has really been down a lot. In fact, it's flat for the year. Now, I got to tell you, as far as tomorrow in this Federal Reserve meeting, I think it's going to be a spark for markets. And I think because it underscores the strength of the economy. But let's face it, all eyes on Washington go way beyond the FOMC gathering. Another issue, by the way, is for this market is crude oil. Crude oil has been in a tailspin. Its inventory levels have continued to surge. In fact, in the most recent count, North America now 1.3 billion barrels. This is by far the most crude oil that we've ever had in storage, which proves that our market is resilient, our providers are resilient, and they can turn things on quickly. But the question now is, should the industry show some restraint? Consider that crude oil wells had dried up. There were only 127 in January 2003, and then we discovered directional drilling and fracking and all of that kind of things that revived the industry to the point where Saudi Arabia had to launch this counterproductive war in late 2014. OPEC drilling increased more recently as prices moved lower, and that forced American producers also to pull back. The price went down, we dropped out, but more recently OPEC blinked. They declared victory, started implementing production limits. That sparked this crude oil rally that has now faded. But it's interesting because now the shoes may be on the other foot, right? Our rigs came back really swiftly. Consider 386 a year ago, now 617 as of last week. But the problem is maybe it's too much too soon, and it could have the same detrimental impact to capital projects, jobs, and obviously stock prices as that OPEC move did. Here to discuss is Matt Smith. Matt, Saudi Arabia launched the war, in my mind, to derail our fracking miracle. I don't think it worked. They more or less acknowledged it. But now our rigs are coming on so quickly, and we've got all of this crude. I mean, is the American oil industry shooting itself in the foot?
To a certain extent it is, Charles, yes. We're in this vicious circle really now where the U.S. has been so successful in terms of those efficiencies, being able to produce oil for such a lower price than even it could just a year or two ago. Suddenly we are perhaps hurting ourselves by this somewhat.
Now, I think one of the problems in America is that we have areas where it's cheaper than others, right? So all the action in the Permian, everyone's down in the Permian. Right. I mean, the numbers are off through the roof. But overall, where do you see crude going if we don't slow down with these rigs and kind of let the market and demand catch up and remove some of that supply?
You're essentially going to get to the point where oil drops so far that it doesn't become economical for U.S. oil producers to produce that oil. And so until we get to that point, they're going to keep on producing.
So they push it to the limit. They're not going to look ahead and say, hey, you know what, let's slow it down a little bit?
No, not at all. This is a capitalist society. They will just keep on going until that point that it isn't possible anymore. Then we see those prices rise again. That then incentivizes more production to come online, and we then do that vicious circle all over again.
So, considering the vicious circle and what we've seen over the last 3 years, do you have an area that you think is the top? In other words, is there a certain point to the upside where oil goes and then it becomes self-defeating because everyone pumps too much?
We are kind of in this band, it would seem. So even if we do see OPEC again say, right, okay, we're going to double down here, we're going to take more oil off the market, it lifts prices up, we may get to 55, something like that, 60 even. Is
that max now? Is that the new modern-day max? I mean, will we ever see $120 crude again?
Potentially not, but never say never in this oil market. But what is going to happen really is maybe in a year, 2 years, 3 years, you're going to get this supply crunch where back in, say, 2014, 2015, these investments dropped off into these longer-term projects. And as they don't come to fruition in 2019, 2020, then we're going to see this drop-off in oil. And then if the price isn't high enough to incentivize, then really we could see prices.
The audience loves cheap oil, right? They love cheap gasoline. Right. And sometimes they get frustrated when we do these sort of segments because it feels like, hey, why do you want oil higher? Well, for me, I want people who could get those jobs, those construction jobs, those oil hand jobs, those jobs that they make a whole lot of money and you build things in this country. I worry about them because not only do those jobs go away, but the people to train the next generation of folks, we don't have welders in this country. We don't have people who can weld together an oil rig. So it's much deeper than how much we're paying for at the gas station.
Yeah, very much so. So in 10 years' time, we may not have enough petroleum engineers, and so that is the concern. But when you have a price at the pump that's $2.30 on the national average here now, it's kind of difficult to make the case for much higher oil prices to the regular consumer.
All right, Matt, thank you very much. Really appreciate it. Like your spiffy outfit. I'm going to try that one day with the no jacket.